Hello my fellow freedom builders and welcome back to the channel. I know you might have been wondering if you were ever going to hear my voice again here on YouTube, and to be honest, I was wondering the same. But I am back now, and it has been, I think, almost a year since I made my last video. But now I'm back. It has been a crazy busy year in 2022, and now we are well in 2023, and I've decided that now is the time to start up the channel again. If it has been a while and you've forgotten what I do in this channel, well, I am doing a lot. I'm talking about my portfolios. I'll be touching on a lot of macroeconomic stuff. There are plenty to talk about. I'll talk about the overall market, some commodities, and also show you how I use options to get around and get a bit of better performance out of the market. But all of that, I'll make a video about that later, because the first video here is about volatility. And I know you might be thinking, why should I learn about volatility? And it is an important factor because a lot of people forget to consider volatility when they're looking at the portfolio. Now, if I had made this video back in, let's say, end of 2020, when everything was going up and all investors, especially the bit more inexperienced investors, were certain that it was so easy just to print money themselves out of the market like a pure ATM, then it might not really have meant much to many investors. But right now, when we have just passed 2022, that was a horrible year for many investors, and the beginning of 2023 here has been a bit tough because many people were expecting the market to start going down or further down in 2023, but instead it has skyrocketed up. People were caught by FOMO, fear of missing out, so they rushed into the market after January because everything was going up, and then things started to drop again. That is a tough market. I know many of you have been challenged a lot by it. So volatility is an important thing, and volatility means different things depending on what investor you are. But today I am going to show you some examples here from something called My Stock Scanner. It's a new product coming out right now, and I have helped develop it, and in a very short while there will be a free version of it where you can track your portfolio and everything else. Right now, as you can see, I have some different portfolios in here, but what we're going to have a look at today is 3 demonstration portfolios. These are not real portfolios. I have not been trading them with real money, but it is a swing trading portfolio that I have tracked back to, I think it's 2017, something like 5 or 6 years, with some very strict rules. I have only been following something like 10 American, some US stocks, large cap stocks, and I'll show you what volatility means. Because the question I often get is, what is your performance in your portfolio, Hans? And to that, when I come up with an answer, people are often a bit disappointed and say, oh, shouldn't you be able to do a lot better because the market has gone up? Well, that was mostly before 2022, but the market has gone up 50 or 100%, or why don't you just invest in Tesla or Bitcoin or something like that? Well, the answer is the volatility. You need to look at what is your performance compared to the volatility in your portfolio, and I'll show you today why. Now let's start out with this demonstration portfolio here in My Stock Scanner. I'll post a link to this My Stock Scanner stuff soon in my next videos. It is all going to be free. There will be a paid version later on, I know, but a lot of it will just keep being free, and you can track all of your portfolios here and get all the core numbers. Now, if we look at this demonstration portfolio, you can see that it has started back in January 2017, and right now we have we have March, but this is tracked up until, let me see here, sometimes at the end of February here. So it's about 6 years. Now, it is a very simple portfolio. As I said, 10 stocks. I have bought with some quite rigid rules, swing trading rules, and you might be able to look at this and say, well, that is not really impressive. A CAGR, a compound annual growth rate, meaning that I have gotten on average around 8% per year in this portfolio measured in US dollars. Now, if we compare that to the S&P 500, the SPY here, you can say that that have made 11.3%. So why would I bother spending a lot of time swing trading when I could get a lot more every year on average than this portfolio? The answer is volatility. The overall return is 64.8% in the portfolio against almost 100% here in the benchmark. But the interesting thing is when we start to look at Sharpe and Sortino ratios. The Sharpe ratio, if you don't know that, I'll make a specific video just about that. But the Sharpe ratio is where you look at your CAGR compared to your volatility. And the volatility, it's a bit of it's an equation, it's just some pure math and statistics, but it basically just shows how large swings there are, how much ups and downs are there in your portfolio. And when someone asks me, isn't the stock market a risky place to be in? You risk losing all your money, but you don't really, not unless you're really gambling. But what you do risk in the stock market, if I draw it here, is that since the market is going up, especially if it's a very volatile market, you do risk having a portfolio that is in this wave and you need your money just when it hits the bottom. So you are forced to sell. That could be you have to buy a house, you're getting a divorce, I don't know, whatever life circumstances hit you, and you have to sell all your stocks right here, which means that you will be losing money on your stocks. That is basically the core risk. If you have a well diversified portfolio, you still risk some volatility. So what we're looking at here is the Sharpe ratio and the Sortino ratio, which basically compares your performance to your volatility. The Sharpe ratio is the overall volatility, the Sortino is only the downside volatility. We want these numbers to be as high as possible, and if we can get them above 1, especially the Sharpe here above 1, that is really outstanding. But you can see here that 8% per year, which is actually a decent performance, we got that with a max drawdown, meaning the worst case at any point from a top to a bottom, a max drawdown of 16%. And the volatility was 7.9%. Well, that is the blue line here. That is the portfolio. And you can see it has been a rough year for some trend following swing trader here since back in the mid 21. That is the last 1.5 years. We have basically gone sideways there. But max drawdown of 16% should be compared to the market's max drawdown of 33%. That was, of course, right in this Corona thing back in 2020 with a 33% drawdown here. But there have been a lot more. We can also see that the volatility in the overall market is 19.4% compared to only 7.9%. So what can we learn from this? Because you might say to yourself, yeah, well, I do want some higher CAGR. I want some more performance. I want some more juice from my portfolio. I don't care if I should take some more volatility. Okay, fair enough. Then let's have a look down here, because what we see down here in the gray area is the percentage of my portfolio, what percentage I have invested. And what you can see here is that at the very top back in 2017, if you look in the little box coming up here, I was only 73% invested, meaning I have actually at no point in these 6 years have my entire 100% of my funding put into the market. So I could do better. I could have more money put into the market. And the way I've done that here is I have tried to mimic what would happen if I actually used leverage. Let's say I used a 2-to-1 leverage, meaning that I have my own, let's say $1 million kroner or $1 million or whatever. I'm putting $1 million into the market, but I'm also borrowing $1 million from the bank. So I'm actually investing $2 million. Well, if we look at that here, we can see that we are actually starting to outperform the market. We are doing over these 6 years, we are doing almost 14% per year. compared to the market's 11.3%. So already now with a leverage of 2 to 1, and just be sure, I'm not really trying to sell the idea to you that you should use leverage. This is a theoretical discussion, so you should only use leverage if your entire investment plan and your economy allows it. So you should always talk to your advisor about that. But we are looking at this 2 to 1 leverage here, and we can see the KGAR has gone up to 14%. We can now see that the Sharpe ratio is about 1. Actually, many money managers would give their right arm to have a Sharpe ratio of 1, but that's another story. The Sortino is also great. But what we can see, and that is of course because our positions have now doubled in size, we can see that our max drawdown has gone up. Before, if we take a look at that here, we can see that the max drawdown was 16.2% and the volatility was around 8. When we look at the 2 times portfolio here, we can see that our max drawdown has now gone up to 25.5%. Still lower than the market, significantly lower than the market, and the volatility only gone up to 12.8%, still a lot lower than the benchmark here. So what we can see over here is that the blue area is now above this gray line. The gray line is the S&P 500, the blue line is our portfolio. And what you can see, if you notice this, is that of course there are times of drawdowns, but for instance here, back in Q4 of 2018, when the market had a real bad time, our portfolio, it was dropping, but not at all as dramatically as the market. When we got to the Corona thing here back in 2020, well, we dropped a bit, but nothing severe. And when the market starting to go up, well, we followed it up. That is what a trend following swing trading portfolio can do. And right now, where we since back in 2022 have had a really bad time, there was a war with Ukraine and stuff, we have gone sideways. If we look down here at the invested percentage, we can see that there have been a couple of times where we have been above 100%. We were at 119% here, we were at 129 here, 127, but it is only a very few times here back in 2017 when the market was roaring upwards here. We were just up using a tiny bit of our leverage, meaning that of course we'll have a few extra costs with our leverage here, but it is a very, very short time span that we have been paying some interest on some borrowed capital here. The rest of the time here, we have actually not been above the 100% mark, meaning we have only been spending our own money. But yet, we are at 14%. And now the volatility has shot up. Let's try and see what happens if we go for a 3 times leverage here. We can now see that with a 3 times leverage, our drawdown has gone up to 35.8%. So now we've actually exceeded the max drawdown from the S&P 500. It was actually not even in, I think it was not even here. The worst drawdown was back in 2018 here. So that was not even with the Corona or the latest drawdown in the market here. But we have exceeded the drawdown a tiny bit here compared to the benchmark. The volatility is just about the same, 19.16 compared to 19.43, meaning that now we have leveraged our portfolio up to a point where we have the same volatility as the market. And that is my entire point of this video, ladies and gentlemen. That is that if you should compare two portfolios, or you should compare your portfolio to the overall market, you need to do it at a point where you have about the same volatility and drawdown, because otherwise it is the same as comparing, I don't know, treasury bills to Bitcoin, where you might say, well, you can't do that because one is completely, almost at least, completely certain and secure. The other one is extremely volatile and we don't know if it'll cost $1 or 10 million in a few years. And that is exactly the same here, just on a smaller scale, meaning that you need to not compare apples to bananas. You need to compare apples to apples, meaning you need to compare the same volatility, the same sort of drawdowns. And if we leverage this test portfolio, this demonstration portfolio 3 times, we actually get to a point where we have the same volatility and the same drawdown. When we do that, we get a Sharpe ratio of over 1, we get a Sortino ratio of about 1.6. Both of them are almost double the benchmark numbers, which is fantastic. And we have a CAGR now making 22.3% per year the last 6 years, meaning that the overall return is 260%, the benchmark is only 97%. That is outstanding results, and that is what you need to do if you want to compare two portfolios or your portfolio to the market. If we take a look down here as how much is invested, we can now see that at some point we have 200% invested, 205% invested. So actually, even though we have tripled the 3 times leverage here, we are only using our own money and then an extra leverage of 1. We are not even at triple the leverage at any point. We could do that, but that would bring our max drawdown and volatility up to some unreasonable numbers here. But that again was back in 2017, beginning of 2018. That is why we got the huge drawdown here in the beginning of 18, where we had some rough markets here. And we were very highly leveraged here, so we got a really bad drawdown here. But otherwise, except from that, the drawdown has not been larger than around 16-17% at any point, even though that terrible crash here back in 2020 came along. It didn't really affect our portfolio that much. So after 2017 and 18, well, we were just up at touching 112% here. Back here in 2020, we were up just above 100% again. But as you can see, we have not spent an insane amount of money on some leveraging cost here. Only a bit back in 17, and that of course should be deducted from the overall number here. Haven't done that in this software, but it is a fantastic software and it's really good at showing your portfolio. Soon there will be a lot of add-ons in here where you can take a look at your portfolios, you can compare it to the markets, you can look at all the fundamentals for all of your stocks there. They're getting some stock scores programmed in and options and a lot of stuff coming. Right now it is mostly a portfolio tool, but all the add-ons will be coming in the upcoming months. This video was simply to show you that if you ask me the short question, how are your portfolios doing? You should expect me to give you a bit of a lecture about volatility, because I cannot just tell you what my portfolio is doing, at least if you want to compare it to the market, unless I at the same time talk about volatility, drawdown, Sharpe ratios, and so on. And neither should you. You shouldn't compare your own. If you have made 10% a given year, you shouldn't compare it to someone making 50% and saying, oh no, I'm just bad at investing. Because if you have had a volatility of only a few percent, and the one, let's say it was ARK Invest with some speculative, disruptive stocks that took a huge dive last year in 2022 due to higher interest rates, well, you should not compare yourself to ARK Invest without looking at volatility. You shouldn't compare yourself to Bitcoin or S&P 500 or any money manager out there without looking at what sort of volatility are they actually investing with. Because if you are investing with this investment manager that almost promise you 20% per year and have done that for years, but he is once in a while losing 80 to 90% of your money, then I think it is the very few number of investors that actually have the stomach to go through drawdowns like this. But if you only have drawdowns of 10% on a regular basis, but still makes 20% per year, it's an entirely other story. That's all for today. I am looking forward to being back here on YouTube. I hope to be able to make 2-3 videos per week, both about single stocks, about some overall macros and fundamentals, and of course a lot about technicals and momentum investing. That's all for now. Take care of yourself and your money out there, and I will talk to you again shortly. Bye.